Most personal finance advice sounds simple and logical. Pay off your debt as fast as possible. Track every dollar you spend. Avoid unnecessary expenses. Live as cheaply as you can. These rules are repeated so often that they feel like absolute truths. But what if some of these widely accepted ideas are actually slowing you down instead of helping you build wealth? The truth is, building real wealth is not just about discipline or cutting costs. It's about understanding leverage, time, and how money actually grows. Some habits that look irresponsible on the surface can actually accelerate your financial progress because they remove friction and help you focus on what truly matters. In this video, we're going to break down 10 habits that might seem wrong at first glance, but can actually make you richer over time. These are not shortcuts or hacks. They are mindset shifts backed by logic, math, and real-world behavior. If you understand these ideas, you'll start thinking about money very differently. Let's start with one of the most controversial ones. The first habit is not rushing to pay off your mortgage early. Most people are taught that debt is bad and that being completely debt-free is the ultimate financial goal. While that sounds comforting, it doesn't always make financial sense. If your mortgage interest rate is around 3 to 4% and the stock market historically returns 8 to 10% over the long term, then putting extra money into your mortgage is actually costing you potential growth. Instead of locking your money into your house, you could be investing it and allowing it to compound. Over time, that difference becomes massive. Of course, there is an emotional benefit to being debt-free, but that peace of mind has a price. Wealthy individuals often understand that not all debt is bad. Cheap, low-interest debt can actually be a powerful tool when used correctly. The second habit is spending more on convenience. At first, this sounds like terrible advice. Why would you spend extra money when you could do something yourself for free? But the real question is not about the money. It's about your time. Time is your most valuable asset, and once it's gone, you can't get it back. If you spend $50 or $60 on something that saves you several hours, you're not being lazy. You're buying time, and what you do with that time matters. You could use it to rest, improve your skills, focus on higher value work, or spend meaningful moments with your family. Wealthy people understand that their time has a higher value than small cost savings. They prioritize efficiency over small savings. The third habit is ignoring small expenses. You've probably heard about the latte factor, the idea that small daily purchases, like coffee, are the reason people don't build wealth. While it's true that small expenses add up, focusing too much on them can actually distract you from the decisions that really matter. Your biggest financial outcomes come from major decisions like your career, your income growth, your housing choices, and your investments. Spending mental energy tracking every $5 expense creates the illusion of control, but it doesn't necessarily improve your financial situation. Your attention is limited, and it's better used on high-impact decisions rather than small, repetitive ones. The fourth habit is buying before you feel ready. This applies especially to investing in yourself. Many people wait until the perfect moment to buy a course, start a business, or invest in tools that could improve their life. But that perfect moment rarely comes. When you commit financially to something, you're more likely to take it seriously. This is a psychological effect where paying upfront increases your level of commitment. Waiting has a hidden cost. Every month you delay learning a valuable skill or starting something new is a month of lost progress. Sometimes, taking action before you feel fully ready is exactly what pushes you forward. The fifth habit is not budgeting down to the last dollar. Traditional budgeting methods often require tracking every expense in detail, but most people give up on this system after a few weeks. It's simply too rigid and time-consuming. A more effective approach is to automate your finances. Set up automatic transfers for savings and investments so that your future is taken care of first. This is often called paying yourself first. Once your savings and investments are handled, you can spend the remaining money without guilt. Systems are always more reliable than willpower. When your finances run automatically, you don't have to rely on constant discipline. The sixth habit is keeping a significant amount of cash You may have heard people say that holding cash is a bad idea because inflation reduces its value over time. Well, that's technically true. Cash provides something extremely valuable: flexibility. Having a cash reserve means you don't have to sell your investments during a market downturn. It also allows you to take advantage of opportunities quickly, whether it's investing in a business, buying an asset at a discount, or handling an emergency. Cash gives you options. It reduces stress and gives you control over your decisions. Sometimes, the value of flexibility is greater than the cost of inflation. The seventh habit is lending money without expecting it back. This might sound counterintuitive, but it can actually protect your relationships. Lending money to friends or family often creates tension, especially when repayment becomes uncertain. By mentally treating the money as a gift from the beginning, you remove that tension. If the money comes back, it's a bonus. If it doesn't, your relationship remains intact. Strong relationships and networks often lead to opportunities that are far more valuable than the amount you lent. In the long run, preserving trust and connection can be more beneficial than recovering a small amount of money. The eighth habit is paying full price for quality. Many people are always looking for discounts, but buying cheap items repeatedly can actually cost more over time. This is where the cost per use principle comes in. If you buy something durable and high quality, even at a higher price, it may last much longer and perform better. For example, spending more on a product that lasts several years can be cheaper than buying a low quality version multiple times. Wealthy individuals often focus on value rather than price. They are willing to pay more upfront to save money and effort in the long run. The ninth habit is saying no to social events. It's easy to feel pressure to attend every gathering, dinner, or trip, especially when friends or colleagues are involved. But constantly saying yes can drain both your time and your money. Being selective about where you spend your time is not about being antisocial. It's about protecting your priorities. Not every opportunity to socialize is meaningful. By saying no to things that don't align with your goals, you create space for the things that truly matter. The right people will understand your boundaries. The 10th and most important habit is living below your means and maintaining the gap between what you earn and what you spend. This concept sounds simple, but it's one of the hardest to follow. As your income increases, it's natural to upgrade your lifestyle. This is known as lifestyle inflation. The problem is that if your expenses grow at the same rate as your income, your financial position doesn't improve. The key is to allow your income to grow faster than your spending. Even if your income increases significantly, keeping your expenses relatively stable creates a gap. That gap is what builds wealth. Wealth is not about how much you earn. It's about how much you keep and invest. The bigger the gap, the faster your wealth grows. This principle is simple but incredibly powerful. When you look at all these habits together, a pattern emerges. None of them are about extreme sacrifice or strict control. Instead, they focus on efficiency, leverage, and long-term thinking. They prioritize time over small savings, relationships over short-term gains, and systems over discipline. Most people focus on looking financially responsible rather than actually becoming wealthy. They follow rules that feel safe but don't necessarily lead to growth. Real wealth is built by understanding how money works and making decisions that maximize your long-term outcomes. These habits might not look impressive on social media. They're not flashy or exciting. In fact, they're quite boring. But that's exactly the point. Wealth is built through consistent, logical decisions over time, not through dramatic actions. If you start applying even a few of these ideas, you'll notice a shift in how you think about money. You'll stop focusing on small, insignificant details and start paying attention to the bigger picture. And that's where real financial progress happens. At the end of the day, the goal is not just to save money. It's to use money in a way that creates freedom, flexibility, and long-term security. And sometimes, the smartest financial moves are the ones that look wrong to everyone else. Disclaimer: this video is for educational and informational purposes only. It is not financial advice. Always do your own research and consult a licensed financial professional before making any investment or money decisions.